So we're going to talk about icebergs. This red iceberg did 3,000 contracts yesterday at 25 even. So you could expect once it's done, it's going to follow through or not follow through, but it's going to break out to the upside. The follow through is what has to be watched. 25 even is important because it will go back bearish if it slips underneath it. So if you're fortunate to get long anticipating this upside breakout, it does go three handles your way. That has to be enough to cover something in case it doesn't follow through. And so as we play this out, you could see the market stay a couple handles above 25. 25 is important because that's where the iceberg order was. And our red lasers start to turn green, which means some longs are coming in, which is some competition. And then it's going to approach 25 even. And if it slips below it is a really good timing mechanism and price mechanism to take your damn horns off and go bullish to at least bearish, or at least not be as bullish. Here's a 200 buy pulse, which is rejected. Now let me pause it. It sits right on these 25s. Okay. It goes green, red to green, which is indicative of a transition. And the longs that got long in there, let me stop it. The longs that got long up there are saying holy SHIT because they can't or didn't get out of profit, because most people, they suck at getting out of losers and they're not that great getting out of winners either. And so what you've seen there, the laser go red to green, which means more longs are competing for upside. The fact that we got through 25 even, which is where that iceberg was, and what made that price unique to what? You? Not just you, but the market. And so it gets below it and it gets bearish pretty quick. Now it doesn't stay bearish forever. And so let me just speed it up, but it does break quite significantly. Where does it come back up and stop? 25 even right here. Oh, is that a coincidence? No, it's because you got a lot of people stuck long as baby birds dying to get out. And so it dips down, comes back to what? 25 even. Is that a coincidence? No. All right. Now, at some point, it's not going to keep stopping at 25 even. Now, another iceberg comes in, 25 even, but he's not doesn't hang there too long, and another 3,000 has to fill. This guy filled pretty fast. Now it breaks out to the upside. It's the second 3,000, and we've got 30 even showing one, possibly 3,000. And I had mentioned, hey, that's 5 handles higher. We might have one every 5 handles. But they're chipping through it. And once it gets close to 3,000, you could try to get long to time it. And let me back it up. Sorry. Let's just play it. It's at 1,640 where my cursor is, 1,715. I don't like when the buy pulses go in and don't go, and it quickly jumped from 1,600 to 3,000. So this wasn't an easy one to catch on the upside unless you were long underneath it. And so same thing. These 30 evens are important. You want to stay at or above it if you're long and you caught this. And so I said, every 5 points we could see, and I say should, some more or another iceberg every 5 points. And sure enough, another one flies up in this once it's identified at 35 even. Boom. The reason why it doesn't appear until we identify is because our filter has to identify that someone who got filled 10 contracts is still offering 10 contracts, gets filled on those 10, still offering 10 contracts, same order, which is then the definition of an iceberg. More than meets the eye. That same order ID is still there, even though he's filled. Because if your order ID is to sell 10 and you get the 10, you should go away. You're filled. If you're still there, aha, you're an iceberg. Now, how many he has left, we don't know, but we know how much he's showing and we know how much he has done so far. And that's this number here. The reason why there's 2 numbers is if he moves it, we could track how much he's done at the new price and the original price. But either way, he hadn't moved it. He's there. And now we're anticipating this to be 3,000 because the other 2 were. And so we have a little edge or a little advantage over understanding this order and how much is left over most of the rest of the market. You can see him buy pulsing it into it, which isn't advantageous to go through it. He's only done 682, so he's got some left. Our laser is red, which is advantageous for shorts trying to get through there. He's done 900, 1,000, 1,100, 1,200, 1,400. You know, if you're long right now, you got to get to 3,000 because at 3,000, you're going to get buyers that miss it to chase it. All right. So that's what's important if you're long. Get this thing to 3,000. You know, it can't be more than that. And you know that after that's gone, people who want to buy it know that the order isn't there to buy it from. And that's what gets the chase. So as you get over 2,000, you know you're close. You know what I mean? So these buy pulses, again, they're not indicative to go because it's like that punch in the face and you can't go. So it backs off a little bit and you make another rotation up, better and better chance to go through it. You know, you only got about 900, boom, 900 to go. And it goes, when it goes, it goes. Let me back this up and show you the dynamics of auction markets. And you don't read about this in books because most people don't understand it this way or can't explain it this way. When someone is selling a lot, and the market knows someone's selling a lot, then people who want to buy it know or think they could go to that person, to that order, and buy it from them because you need a seller to buy from. If you have to buy it or you want to buy it, you need a seller willing to sell it to you. Well, in your mind, you have a lot of selling at 35 even and a big order at 35 even. So you say to yourself, well, I'll just buy it when he's about to go away. So you lean on an order. That's what's called leaning on an order. In this case, leaning on a sell order because you're a buyer. You want to buy it into that sell order when it's close to being done. The problem is most people miss that. They miss that ability or that opportunity to buy it. Let's say you're short, not physically, but you're short with respect to your position in the market. If your position is short, you know, and I know you're a buyer to cover that short. That has to make sense to you, correct? Now, here's what's important. When you're short and you turn into a buyer, which you do, and you're like, well, I could be patient until this guy is done. There's a lot of sell orders, and that's what I want. And then it's gone, and you still are a buyer. You become the reason for the breakout. All these shorts that wish they had bought it when this guy was selling a lot that didn't are the chasers. And it's one of the dynamics that make price to do what it does. Let's not kid each other. If you don't know why price moves, how are you going to predict it? And so right in here, he's got 2,100. We know he's close to being done. We know he's only going to have 3,000. And we know at 40 is probably the next iceberg. And boom, it's gone. And all the people that are trying to chase it or wish they would have bought it and everything else are the reason why it blasted up 3 or 4 points. Got it? Now, the people who caught it long, if there's too many of those, we start to go back to where we started. If there's too many of those. And it'll be support, and then it's like a pivotal moment, like those 25s were earlier in this video. And so you walk this thing back and forth, and it maintains its strength. And I think he came in one more time at 35 even for a total of 4 orders totaling 12,000 contracts. But what's really interesting is this helps people understand the mechanics of price. And the why price moves, man, is so important to be able to understand why price moves in order to give yourself a chance to predict it. If you don't understand why, then you're not going to understand the how, the where, the when. If you think about anything in your life that you got good at, developed a skill, there was a moment that the learning you were doing turned into understanding. And those are the clickable light bulb moments that you'll have, the aha moments, the epiphany, whatever word you want to use. And so understanding a lean, when buyers are leaning on a big sell order and that sell order goes bye-bye, those buy orders are still there and they got to go and chase and try to get filled, only now at a higher price. And when you then are able to define buyers better, how do you define buyers better? Not just size, but you define buyers as those who are short that have to cover. That's one definition of a buyer, covering a short. Why is that an important definition? Because they're probably going to be anxious. Why? Because they have to do something. when you're a buyer to cover a short, you have to buy it at some point, right? You're not going to stay short forever. You have to cover and square that position off. And if you're a buyer to get long, you don't have to do it. You want to do it, but you don't have to do it. But when you're a buyer to cover a short, you have to do it. And anytime you have to do something, you are more emotional, sometimes too emotional, but at least more emotional. Does that make sense? Anytime you have to do something, there's a little bit more emotion that's going to creep in. And that's why when you have shorts that are on the run, shorts that are getting squeezed, shorts that are taking heat, and all the rest, is one of the reasons why price goes up. Too many shorts, too many buyers, the price of anything tends to go up. And it always reverts back to the why price moves. That has to be your default. That has to be the foundation of your training. Or else you have to think about where the brake pedal is when you're driving and the guy in front of you slammed on his brakes. There's no time for thinking anymore. There's no time for that when you're a good driver. In fact, you don't even have to wait till the guy in front of you hits his brakes to know he's going to hit his brakes, because the guy in front of him cut him off. And a good driver is anticipating what's going to happen to the cars around him before it happens. A good trader is anticipating what price is going to do before it does it, or else there's no opportunity to be able to exploit it. If everything and tool you use is after the fact, there's no value. You have to be able to anticipate, strip randomness out, and when it happens, it doesn't feel like a good guess. It doesn't feel like you got lucky, because that's not going to last. You have to understand what an edge would be and then find the tools that reveal that edge. If you can't define what advantage or edge you're looking for, how are you going to find one? You think you're just going to get lucky and know how the ball is going to land on green, red, and roulette? You think you're just going to get lucky with some simple chart pattern in a book that you read? No, you're going to need an advantage. You're going to need an advantage and a skill to read the other players at the table, and sometimes a skill to know what the next card is coming out of the chute. And we don't claim to have that, but we do have the ability to see a sample size of other people's position, where they got out or puked, where they're getting in and accumulating. But the reason why we know that's important is because we already know the value of knowing other people's positions to begin with. And I always help people, and this goes for everybody in the room or out there who's never heard of me or this before. And that is, number one, it looks like there's a lot of things going on the screen. There's not. It's just different time periods of the same thing. That's number one. Number two, if you ever want to learn and take the learning into understanding, all right, learning into understanding, I'll just use you for understanding. That's the only way you develop a skill and can truly say you get something. But one of the ways to do it is anybody who's traded before, which is most people I would imagine watching this video, they've traded before and maybe a lot. You know how you feel when you're in a particular situation, right? When you're long from a particular price, guess what? That price is unique to you, isn't it? You're damn well right it is. When you're long, that price is unique to you. When you got stopped out, that price is unique to you. How did you feel when you were long and wrong? How did you feel when you were long and had profit and that profit went away? So identify how you feel in those different scenarios and know that that's how the market feels if most of the rest of it is in that scenario. If a lot of people are long and markets are running away from it, all of a sudden you know how the market feels, because that's how you feel. If you can identify that the market's too long. If you can identify when the market stops you out from a long, how many times does that happen? And then it just rallies. Yeah, fine, they stop me out, and then it goes. You take it personal. Well, in that particular scenario, the market was too long. It had to stop everybody out in order to go. It's not personal. The market wasn't trying to get you. The market was doing what it needs to do in order to function. It cannot have too many people on the boat in order to float. It has to shake some of the weak hands out. Too many longs, too many sellers, we can't go up. So the market's just doing what it needs to do in order to function. Just like a boat would have to do what it needed to do to float. And so when that happens to you, you get stopped out of a long and then it rallies. It's because most of the people were long and a lot of people got shook out. How does that feel? So when prices are unique to you, it doesn't mean anything. Most of the time, doesn't mean anything. I'm just trying to get you to know how you feel in those different scenarios, because now you're going to know how the market feels if a lot of people are stuck on that side. When the price is unique to the market is what's going to allow you to read and predict better. When a price becomes unique to the market, and if there's a price a lot of people got long from, it's unique to the market. Just like it's unique to you if you got long from that price. If you got long from a price and it did nothing but give you heat, right? You took nothing but heat as soon as you open that long position. Uncomfortable amount of heat. Now you're a long, which means you're a seller or a buyer to get out. Seller. We should all know that. You're a seller to cover this long position. You've taken nothing but heat as soon as you bought it. And now it's coming back to get you a break even. Right? Right where you got long and suffered all this pain. Chances are you're begging as a seller to get out as a break even. I'll never do it again. I never want to feel this much heat. I feel like I got just let me out. And you're a seller at where you got long and were wrong from. Now, if it's just you, it's still unique to you, but it really is not going to have much market impact. But if a lot of people are long and a lot of people felt this way, then this is going to have a market impact. And there's going to be a lot of sellers and they're going to be emotional and they have to do it. And that's when it's going to be one of the better resistance areas in this and on this chart, where it's going to go up to it and start to fall off. And these sellers are going to screw it. I'll sell it there. I'll sell it there. I'll sell it there. I'll sell it there. And that's when you get this chart to go down, to come up, use it as resistance and come back down. If there's a moment where there's a lot of stuck longs in this area and they took this heat down to here, when it gets up in here, they're begging to get out as sellers. And when sellers beg is when you get an area that then becomes great resistance. And that becomes the definition of resistance. If you can't define it like that, if you don't understand it like that, start understanding it that way. Or think of watching videos on how to become a plumber or a chef or bake cakes. You got to take your learning and understanding. And if you don't know why price moves, you have no business predicting it.